Hi, this is Akash back with another exciting reading on alternative investments. Uh, in the last class, I'd say, sorry, not another reading, another, what do I say, video series on alternative investments. Okay, in the last video, we discussed everything as per the LOS requirement and even extra, okay, for real estate and hedge funds. Okay, right now we'll directly jump into commodities, okay, as a uh, asset investment alternative investment asset class. Okay, my suspicion is that 3 out of 10 questions, okay, would come from this topic. So to start with, exposure to commodities is important. Firstly, buying physical commodities is not recommended because it entails a lot of storage, transportation cost, and it is, excuse me, it's really cumbersome. Secondly, we can have exposure via derivatives. Thirdly, but the stocks of companies which are a pure commodity play. Fourthly, buy ETFs, example the gold ETF in India. Fifthly, investors can go for managed futures, a fund that operates like a hedge fund wherein the limited partners contribute capital and the manager invests in commodities either actively or passively. If the managed futures is in the form of limited liability versus mutual funds, in mutual funds it is accessible to retail investors and has higher liquidity, while in case of LLP, limited liability partnership, there is a higher limit on the minimum amount to be invested, and also there is a limit on the number of investors. For wealthy investors, there will be a separate fund manager who will manage their funds separately. Given that an investor wants to invest in gold via equities and there are two companies, A and B, both the companies are similar in all aspects, but A has other businesses also while B is solely dedicated towards gold, so its correlation with gold will be lower. If the investor wants to take a position in gold, ceteris paribus, okay, no bias towards the management of the company, no prospects and all, we would recommend that the investor invests in equities of company B. The potential risks and return in case of commodities are: negative aspects include lower returns as compared to traditional asset classes, high volatility, and a very low Sharpe ratio. The positive aspects include a low correlation with other asset classes, significant diversification benefits, and hedge against inflation. The factors affecting price of commodities: on the demand side, we have a dependence on the economic and business cycle. On the supply side, the commodities primarily depend upon production, inventory, storage cost, extraction cost, and so on and so forth. In the short run, supply may be highly inelastic, such that if demand shoots up, price will rapidly rise, and investor gains on this front. There is a relationship between the forward and spot price, and trust me when I say this, this is 99.99% guaranteed to come on the exam. Okay, it is sure shot that a question from this topic will come. Okay, so we know that the forward price is known today. Okay, it is a contract to buy or sell a commodity later at a predetermined price. So F should be greater or less than S. Mr. A person is bullish. He buys the commodities, buys the commodities and pays. While there is another investor who enters into a forward, Mr. B, he gains. So Mr. A, he's bullish and he pays and buys the commodity, while Mr. B enters into a forward. Okay, so forward price will be greater than the spot price. Forward price plus interest saved because of the gain. Forward contract is bad because it provides no convenience yield, the benefit that the commodity can give if it is owned, but forward on the commodity cannot give. The forward price is the spot price plus interest plus storage minus convenience yield. If the convenience yield outweighs interest and storage costs, it will be a situation of backwardation. Forward less the spot price. If forward is less than spot price, it is a situation of backwardation. If forward is greater than spot price, it's a situation of contango. This, as I said earlier, it is my suspicion that this question will come on the exam. There are two kinds of hedgers, okay, the producers of commodity and the consumers of the commodity. the producers of the commodity, okay, they're afraid of oil price falling and thus they sell futures. This is known as a short hedge. While the consumers are afraid of price rising, assume you and me, we are afraid of price rising and so we go F plus, and this is known as a long hedge. What are the sources of return from commodity forwards or futures? Change in spot price. If the spot price changes, so does the forward price change, and as a result, it leads to a gain or loss. Collateral yield. If we take a position in commodity forward or futures, we keep margin, which can be in the form of collateral security, hardcore money, shares, etc. Daily repricing is done. An active fund manager does it so actively that which collateral to keep, and when to do that, we get a refund and a margin call is there. Roll yield. Instead of buying long maturity futures, we can buy futures at each time interval and sell it the next time interval. This is rolling over. The nomenclature is so intuitive. Rolling yield. In order to understand roll yield, we assume that the above two sources have understood to be constant. We enter into short-term futures. When maturity comes, we roll it over to the next future. This means we square off that original future and enter into a new short-term future. Assuming F plus, roll yield will be positive in case of backwardation and negative in case of contango. The reverse is true for F minus. However, to understand roll yield better, we need to assume ceteris paribus. The spot price is constant. In case of short position, roll yield will be positive in case of backwardation and negative and positive in case of contango. Feel the activeness in the rollover. When exactly to roll over, how much to roll over, and all these are active decisions that need to be taken by the portfolio manager, by the commodity manager in this case. Compared with purchasing commodity, long position in commodity offers the benefit of no storage cost. An investor who wants to hedge inflation by allocating a portion of portfolio to alternative investment should most appropriately invest in real estate and commodities. Compared to traditional asset classes, investment in commodities has exhibited lower returns and higher price volatility. The component on the yield on a long only commodity futures position that is independent of whether the contract is in contango or backwardation is the collateral yield. Commodity index as an active strategy while indexing as a passive strategy. An equity fund manager decides to replicate the Dow Jones Industrial Average Index, but constructing a portfolio of 50 stocks in the same weights in which they are present in the DJI. When share price of these 50 stocks change such that the weight of these 50 stocks in DGIA changes, there is an automatic change in weight of these stocks in the portfolio. So, has the equity fund manager chosen the stock? No. Does he need to buy and sell the stocks to rebalance? No. So, equity indexing is a passive strategy. However, commodity indexing, a commodity portfolio constructed through the commodity exchange, is an active strategy. Why? Because the manager needs to take care of collateral management. Commodity portfolio consists of commodity derivatives and commodities. So, rollover comes into play. The weight of commodity in the commodity index is based on commodity production or consumption. As weight in the index changes, there is no automatic change in the commodity portfolio, and so the fund manager has to rebalance the portfolio. Moving on to private equity funds. My suspicion is that around 2 to 3 questions, would turn up on the exam. Private equity PE funds are organized as LLPs and managed by a managing partner MP. The limited partners contribute capital, and here we primarily talk about wealthy individuals. The managing partner invests in a portfolio of companies, say C1, C2, C3, and so on, depending upon relevant strategies. If the company is a startup, there is a huge probability of profits, and so is the huge probability of losses if the product or the technology under consideration turns out to be a failure. This is known as a venture capitalist fund, and these are not listed on the stock exchange. If the company is a distressed one, cannot pay loans, interest, salaries, operating expenses, fixed costs, but there is a turnaround strategy by change in management, the managing partner can invest and take part in active management to give direction to the turnaround strategy. If the company belongs to an industry with low business risks and stable cash flow, but there are issues with the management, and it is visible that a change in management, that is a management buyout using debt, will lead to higher returns, huge returns, the manager would do so. There are various private equity strategies, distressed securities, which we discussed above, okay, developmental capital or minority equity, where suppose a company X Limited is a small entity and is now planning for major expansion and is ready to divest a minor stake, which a private equity fund picks up. A leveraged buyout. Okay, here we discuss about management buy-in, where the existing management buys in, and a management buyout where the existing management does so. Okay, so firstly, the management uses debt to buy the equity of the company and then converts it to a private limited company. If this is done by an outsider, then new management buys in. It's known as a management buy in, and they become the new management. If it is done by existing management, it is known as a management buyout. We have a leveraged buyout as well. We have venture capitalists. Okay, under venture capitalists, okay, there are various stages of investment such as angel investing, when the idea generates, seed capital, where venture capital steps in to provide funds for developing and marketing, early stage where funds are needed for commercial production and sale, the later stage where funds are needed for major expansion, mezzanine stage where funds are needed for FPO of shares. These all strategies are private equity strategies, and really dominant, where the managing partner tries to invest money and have some positive return out for the limited partners. We finally have something known as private equity exit strategies. Okay, so it's not about just investing in the company. Okay, the private equity, the managing partner wants to not remain invested forever. Okay, he wants to leave the company after investing. Okay, so what are the exit strategies? The private equity firms usually hold companies for an average period of 5 years, but holding periods can vary from 6 months to 10 years as well for individual companies. Determination of appropriate exit strategy requires an evaluation of industry dynamics, overall economic cycles, interest rates, and company performance. The common exit strategies are the following: by an initial public offering. This involved taking the private company public. A strategic sale, okay, where we sell our stake to a competitor. Okay, then there is something known as a secondary sale. This involves the sale of a company to another private equity firm or group of investors. We have something called recapitalization. This is a very popular strategy when interest rates are low. Basically, the PE, a private equity company, uses debt to fund a dividend distribution to the equity holders. Strictly speaking, this is not really an exit, but recapitalization is considered to prelude to a later exit. We have something known as a liquidation. Okay, we have something in terms of liquidation. This occurs if an investment does not perform well. The private equity firm liquidates the portfolio company to move on to other products. What are the benefits of private equity investments? Okay, private equity funds have earned higher returns than equities over the past 20 years. Based on standard deviation of historical annual returns, private equity investments entail higher risk than equities. Private equity returns have less than perfect positive correlation with returns on traditional investments. So, there are diversification benefits of including PE investments in investment portfolios. However, before reading too much into these results, it is important to bear in mind that, like hedge fund indices, PE return indices rely on self reporting. Therefore, they are subject to survivorship and backfill bias, both of which lead to overstated returns. Furthermore, in the absence of liquidity event, private equity firms may not end-to-end mark-to-market their investment portfolios on a regular basis, which leads to understatement of volatility and correlation with other investment classes. Evident, Evidence also suggests that identifying skilled private equity fund managers is very important, as differences in returns between the top and bottom quartile of PE funds are significant. Further, the top quartile funds tend to persistently perform better than others. In terms of due diligence and investment considerations, following factors need to be taken care of while investing in a PE. the current and anticipated economic conditions. Portfolio companies have a better chance of doing well if the economy is strong. Since private equity funds take on significant leverage, interest rates and capital availability expectations must also be considered. Then the quality of the general partner is also important. The limited partners or the investors should examine his experience and knowledge. Okay, the valuation methodology the general partner uses, the alignment of general partners incentives with the interests of the limited partners, the plan to draw on committed capital. Okay, the planned existing strategies, our entire roadmap whether or not is prepared by the general partner. So this was a intense discussion on the different alternative investment asset classes. Now we'll move to our final LOS, which speaks out to describe risk management strategies of alternative investments. There are a couple of risk management issues. Investments in certain type of alternative investments require long holding periods. As I already said, it's an illiquid one. For example, private equity funds and hedge funds have certain lock-up periods. Okay, hedge funds and private equities are less transparent than other investments, as they may consider investment strategies with proprietary informations. Illiquidity is another big issue. Risk issues for implementation. Okay, large investors can diversify across managers, but small investors cannot. Indices are widely used to track the performance of several types of alternative investments. Historical returns on those indices and the standard deviations of their returns may not really be representative of the risk return characteristics. Reported correlations, okay, can be different from actual correlations. The hedge fund managers who has incurred large losses tends to liquidate the fund instead of trying to offset losses. Okay, these are issues in terms of implementation for the different asset classes and the alternative investments. I prefer to call it as alt-inv. Okay, so yeah. And finally, coming to the risk return measures, given the illiquid nature of alternative investments, estimates of value may be used for valuation purposes. As a result, return data may be smoothened and lagging, and standard deviation may be understated. This makes the Sharpe ratio an inappropriate risk return measure for alternative investments. Further, the distribution of returns for most alternative investments is non-normal. Returns generally tend to be leptokurtic and negatively skewed. As a result, measures of downside risk are more useful. Downside risk measure focuses on the left side of the returns distribution curve. These include value at risk. This estimates the minimum amount of loss expected over a given time period. Safety first or the shortfall first measures. They measure the probability that the value of the portfolio will fall below a minimum acceptable level over a given period. These measures use the standard deviation, so they underestimate risk for negatively skewed distribution. The Sortino ratios used for hedge funds is another measure of downside risk. Uses downside deviation as opposed to standard deviation as a measure of risk. It is important to understand and evaluate tail events, that is low probability, high severity instance of stresses when it comes to certain types of alternative investments. Stress testing, scenario analysis are common tools that need to be performed to understand potential losses for these investment vehicles. Thank you.